Okay, let's do a Q&A session from Sunday's Market Outlook. By the way, 34.1 hours average weekly hours is COVID level. It's bottom actually. The number was lower only during great financial crisis. I think I have that up here somewhere. Let's just have a look at this. We'll just slide this across here because I did call it up. There is average weekly hours, all employees, total private, 34.1. Down here we can see that COVID level is 34.1 as well, and you do have to go all the way back to the great financial crisis to get under 34, so that is in that respect rather low. Let's just get rid of this here. Most of IWM constituents finance on the short end of the curve. So if EFFR drops, that would be more beneficial than long end drop, at least for earnings. If you're talking about loans, not bonds, but loans, leveraged loans, more than likely they borrow on a floating rate, probably with caps. They probably have to buy interest rate caps as well. And whether or not they have hedges in place for interest rate risk is another question. It's usually not so much the change in the rate for the change in the interest expense, but the change in the rate for the incremental new borrowings to finance growth that matters more. So that is sort of the bigger deal. Can you elaborate on the relationship? Actually, I shouldn't run past it that quickly. So if you do have short rates dropping, it incrementally does help, but not as much as a good growth environment does. There's only limited amount of help that this can provide to you. It's not going to make the big difference that would justify, let's say, 60% earnings growth or 40% earnings growth. It may provide some incremental benefit. But if rates are dropping on the short end of the curve, it's either because the economy is slowing down, which is not a good environment for growth, or because inflation is subsiding, which inflation it feeds right into company revenues, right? So you would expect that the growth rate in your revenue as a function of inflation would be lower. Can you elaborate on the relationship between the 10-year and IWM-SPY? I don't understand the significance of 4.5. Well, I don't know that it has a numerical or a quantitative significance as much as a psychological one, but I have noticed that as the 10-year pushes above 4.5, beta doesn't perform very well at all. And as we push down below 4.5, it seems that rallies are supported more often with rates with the 10-year under 4.5 than above 4.5. It just could be some point that the market has attached itself to 4.5, right? As opposed to 4.43. It just seems to be a tipping point. What the theory behind the number is, I don't know, other than being a widely accepted narrative around 4.5. Have you considered adding a fixed income section to the applied level? I don't know that would help very much. There are very few brokerage accounts that allow you to buy fixed income directly. Fixed income is still a dealer market, even though some are listed. IB, Interactive Brokers, has bonds that are listed. It's not as for a lot of smaller accounts, it's not as liquid as you'd like it to be. That if you were trying to buy 1,000 or 2,000 in bonds, you might be sitting there all day waiting for that small order to be picked up. So it's not as big a thing for retail accounts. I don't know that it would be very useful. What type of books do you read recreationally? I don't know that I would separate what I read into work versus recreation. I feel I recreate all day long. What are some books you recommend young people to read? or a must read? Fiction, philosophy, history, or just any? Read as much history as you can. I'm not a big fan of fiction because I don't know what purpose it serves other than entertaining. You can find very good entertainment with history. Same with philosophy, some very good entertainment there. If your mind works that way, where you're entertained with something more serious, lots of good documentaries on YouTube. Type in space, science, wildlife, history. Like, if you're gonna just watch some stuff, watch that stuff. IBA does not do margin calls. They auto liquidate. Well, they don't do margin calls in the sense that somebody calls you up and says, hey, you got to deal with this. But if you look at your available liquidity, it turns yellow. There's a big yellow sort of highlighter bar that runs right across that line. So it does do a margin call. When it turns yellow, it's telling you, hey, you've got less than 5% liquidity. You're going to have a problem really soon. And then you just keep watching that number. It'll turn negative. It's up to you. They're not your parents, right? It's up to you to monitor that level. And when you see it when you see that yellow bar, you should start taking action right then and there. But when it turns negative, if you don't fix that by the end of the day, they will auto liquidate because they feel, we've already told you. We turned this thing yellow at 5% liquidity. You did nothing. It turned negative. You did nothing. Okay, you've been notified. Because of this, I'm thinking of moving to another broker. But they all have higher margin interest. To work around that, is it possible to use box spreads to borrow money at a very good rate? How is box spread borrowing money? Have you used box spreads? I have. They're illegal in Canada, but you can use them in the US. Are you planning on doing an applied series about box spreads? Not really. It's more of a risk management tactic. Box spread is you're long and you're short. So you set up a situation in which you're long something and then you're short the very same thing you're long. Usually with the same security. So in a US account, I can be long, well, that's not a good color on white, right? I can be long 1,000 shares of GM, and I would be long with a buy to open. Even if it's stock, you can buy to open. And I can sell to open. I don't have to sell to close. I can also sell to open in the same account and have negative 1,000 GM in the same account. So basically, I have 0 GM at that point. The money that I was long, I am now short. So I have that money to use somewhere else at that point in time. But what are you hoping to accomplish here? What's the difference between, let me just sell the 1,000 GM and have 0, and I've got my money now? Because if GM drops, your short position will drop, but your long position will drop as well. If you had sold your position and GM dropped, well, you could just buy it back at a lower price anyways. No matter what happens, if GM goes up $2, well, your short position loses $2. It's not as if you're borrowing money here. You're really just taking I think a long way around from just selling the position that you have. Unless you feel you only need it for a day, in which case, I don't know. I'm not seeing how the box trade is going to fix a margin requirement at all. If you have 1,000 GM and you need to fix a margin requirement, sell a call. Or if you have some short puts, let's say, and you need to solve a margin requirement, buy some really cheap puts down here. Just go a little bit lower in the market and buy some puts. You'll turn an undefined risk position into a defined risk position, and it will lower your margin requirements and untie some capital. There's lots of things you can do other than a box spread. Better understand your words, your market outlook. Not sure logical flow how DOGE will affect aggregate demand. If the U.S. runs a balanced budget, the fall in government spending is the same as the fall in tax revenue. No, it's not the same as the fall in tax revenue, but I see where you're going with that. So let's think about it and make sure we catch all the non-linearities as well. Let's say that there is, we'll take the political example, they're getting 9 million, and let's say they're no longer going to get that 9 million. So somebody doesn't get it to spend. And let's say the government is borrowing, and we see that that flows through to borrowing, that they were going to borrow 50 billion, 9 million. Instead, they're saying, okay, well, we only need to borrow 50 billion now. We don't need to borrow 50 billion, 9 million. We'll do this two ways. We'll do a 1 year and we'll do a 10 year. Now, we're in a deficit position. So it's not as if the 9 million is incremental savings. It's just less borrowing. So we decide to only borrow 50 billion instead of 50 billion, 9 million. And let's say that we were borrowing at 5% as an example. Well, if the market sees this, we can't just linearly say you're going to borrow 9 million less, this 9 million will go somewhere else. It's going to have an effect on the yield. Every 1 basis point is $5 million. So if you go from 5% down to 4.98, the proceeds you raise by saying we don't need this extra 9, we'll just do the 50, would be $10 million higher. So the higher prices would mop up the other 9 million somewhere else anyway. So it wouldn't be free to float around out there. Let's make it a 10-year, because the 10 years at par. Instead of raising 50 billion, 9 million, you raise 50 billion. Now you do have that 9 million floating around out there. And let's just say that it only drops to 4.99 instead of 4.98, meaning $5 million. So what is this saying? It's saying during the first year, the Treasury will spend $5 million less in interest payments, but it will do that for 10 years, thereby taking $50 million out of the economy over 10 years. So this 9 million will be offset very quickly. But that 9 million, it's not as if it was looking to buy something and suddenly now it's going to stay in consumers' hands and be spent. That 9 million probably belongs to the Treasury market. It's going to find a home somewhere else at higher prices. So what would happen in a deficit position if the market sees that a dollar in savings is translating directly into a dollar in less borrowing, is the price of everything would increase, so that the same amount of money would flow in. All of it would just buy slightly less than it bought before. Now run a balanced budget so that you have a certain amount of debt outstanding, but you're not adding to the debt. It's constant. And there's a constant level of debt. And you're balanced, which means all of your expenses, including your interest, are paid for. And you decide, okay, well, we're going to cut spending by 9 million. So you have a surplus of 9 million. If that flows through in lower aggregate taxes by 9 million, now you're leaving that in consumers' hands. It's just a shift in aggregate demand. The government won't spend it. We'll leave it with consumers. They will spend it. But if it doesn't show up in the tax rate, if it doesn't show up and stay with consumers, it's more than likely going to be reflected in higher prices. So it's not as if, there'll be 9 million left to be spent or lent somewhere else. It's just know that it will be mopped up in the higher prices that would exist because of the rate of change of the debt issuance. So that's why I'm saying in a deficit position, the government saving $9 million is a drop in aggregate demand of 9 million. And if you are issuing less coupon paying bonds, with the savings in interest over those many years, it's taking that much money out of the system that would have flowed through to somebody somewhere. Somebody somewhere would have gotten that, right? So I don't think I have to read the rest. I think that sort of answers it all. I've completed all levels of C of A curriculum. I'm an applied level subscriber. I've got no real world experience as of now, and most of it is conceptual knowledge. Let me just erase this here, and I'm going to move my little menu thing over here. I struggle with having conviction in researching and making investment decisions. Have that confidence to think I know what I'm doing. Being inexperienced, I also have difficulties in interviews at my desired roles that I want to pursue. How do I go about building that confidence and turn the concepts into applicability without experience? Well, you might be suffering from imposter syndrome. Imposter syndrome is when you know something, but you're aware of how much you do not know. So you know quite a bit, but you're aware of how much you do not know, and you think that if you speak on any of that stuff, somebody else somewhere will call you out and say that's not what that is. And you're afraid of looking like you don't know what you're doing. You're not confident in what you know. And the other side of that is that you know nothing about something, but you think you know everything. So you're overly confident in everything you say, and you're so wrong, but you can't even see that you're wrong because you think you know it all. Right? So it just could be a form of imposter syndrome. I don't know an easy way around that other than to just jump in. Start a paper trading portfolio and just start making trades. And see what your performance is like. See if you can, earn, even if it's in a less behavioral way. You make different decisions with real money than you do with paper money. But just jump in and start applying what you know. Document. Say, well, I see this going on in the market. Here's what I think I would do. I would buy this. I would buy that, and see if it works out. You can imagine that all of those decisions would have been, if they were real dollars, that your logic got you to those decisions. See how they work out. What are your opinions of a monthly contribution plan for retail investors? Absolutely. You have to have that. Businesses do this. They reinvest their retained earnings to grow bigger. It's the same thing with you. Your retained earnings are your savings. Right? Your revenue is your income because you're selling your time. You're selling an hour of your service in the marketplace for some amount per hour. That is considered your revenue. You have your expenses, and then you have your net income, which is your savings, which should add to your equity. Right? Some people don't add it to their equity. They just spend it on assets, not even assets. They spend it on stuff that depreciates in 3 months to nothing. A pair of running, the seventh pair of running shoes. What do you need 7 pairs for, right? So if you have a contribution plan, it's basically reinvesting your retained earnings to build equity. Yes. I know you've talked in the past. Not everyone will have a speaking role in Discord. Correct. Have you determined what the requirements will be? Well, first and foremost, the Discord is for the applied level subscribers. First and foremost, it is for them. So the first step is getting all of them in, and all of them will, because they're in applied level subscribers. It is for them. And then I thought, well, there are other people who have qualifications. Let's bring them in. Because we want to create very good conversations. I want to avoid some of the comments that typically show up in YouTube. I want to avoid some of the scam stuff that shows up. You have no idea how many of those things I delete every day. 40, 50 of these. Oh, this person? I'm surprised to hear her spoken of here. Oh, she's on Telegram and this, and like that kind of scam shit. I delete 40, 50 of those things a day. That's why if you go through most of my comments, you never find them, because I'm very active on that. And then I want to avoid the comments from viewers who are just not ready to contribute to a more meaningful conversation and sort of detract away from the desire to have the conversation, because you have, sometimes you get these yahoos in there that don't know how to construct an argument. They just know how to call you names. And they don't actually contribute anything. They just take away from the conversation. And there, so there'll be a Discord, and then in there you always have private. You can have private channels, right? One of them is going to be ultra private because there are some people who cannot have public conversations. But if it is invite only, if it's exclusive, they can have conversations. That one will be fairly exclusive. And then people, I haven't really gotten everything down of how I want this done. My first goal is to get all the applied level subscribers in there. I mean, that's the first goal. Once I'm done that, I'll think about how others come in. But this is not a public forum. It's kind of like a private club. And a private club requires membership in a private club. That's all that thing is going to be. There's another comment somewhere that says behind a paywall. This is not behind a paywall. There is no charge for this for membership in this Discord. There is no charge. If you're an applied level subscriber, this just comes with it. If you're not an applied level subscriber, there is no charge for it. It's just invite only. I am hoping to elevate the conversation such that if somebody says, I'm looking at this company, I don't understand this line item, that you get, a bunch of good answers to that line item where everybody can learn something that they didn't know before. Because everyone knows something, at least in their domain, that somebody else doesn't know, right? And it's not about giving away proprietary information or insider trading or anything like that. It's about like-minded people who are trying to find the answer to a question, and they want to know that the people answering have the qualification to answer. You don't get that on YouTube, right? You don't get that in Reddit. You don't know who these people are who are answering. But I'm vetting everyone coming in of the qualifications, and based on the qualifications, those are the permissions to engage in conversations. There were steel and aluminum tariffs set on Monday, correct? Do you have any idea how to best predict these? Trump, well, let me start a different way here so you understand where I'm going. To determine or to have some ability to expect, because the market is all about expectations, is what do you expect? You have to have some model that helps you determine what the expectation might be. Economics is full of models, and some of them are useful. The success of a model is not how well it represents reality. It may not represent reality at all, because you have macro and you have micro, right? And the uncanny thing about this is you can get a whole bunch of changes in the micro that don't add up to much at the macro. So you can get a lot of volatility at a micro level that add up to fairly repetitive patterns at the macro level. A good example of this is miles driven in the US per year. You have new cars coming on the road, old cars leaving, people moving from one city to another. You have a whole bunch of movement at the micro level. But if you look at miles driven per year, it's fairly constant. And has a fairly constant growth rate. How can that be? How can you have such stability at the macro with such instability at the micro? That's just the nature of how all the actions at the micro tend to cancel each other out over time. So you need a model that is useful. Useful meaning it helps you predict certain things even if you cannot reduce it to the micro. So there are certain inputs you can use to determine the direction of GDP, for example, to determine the level of investment, to determine how jobs are going to unfold. Big, broad macro events like that. Well, with Trump, you need a model. And again, the model does not have to reflect reality. It just has to be useful. So once you have a model of the fiscal, which is what's going on in the U.S., in my opinion, in my model, the fiscal is one person. It's Trump. That's all the fiscal is. You can agree or disagree, right? You can create your own model. You could say, oh, that's not true. It doesn't matter if it's true. It does not matter if it's true. It only matters if it's useful. And then I use this model. So I have a description of the person, and I have a motivation. And I then use that to determine what the likely outcome is going to be. Is it useful? Yes, it is. I do quite well on Trump. I hope he keeps doing what he's doing, because he's super easy to read, at least with the model that I use, the model that I have created to sort of, describe what he's more than likely to do. I think my model is so good, I can tell you exactly what he's almost exactly what he's going to say next about Gaza. What I can tell you what his angle is with Ukraine and Russia, and I know exactly what he's doing. At least my model gives me the belief that I know exactly what he's doing. Yesterday, based on what he was saying about steel and aluminum, based on my model, I shorted the market because I knew he would do it. I didn't know. I put a high probability on him doing it. Last week, I put a very low probability on him carrying out tariffs against Canada and Mexico across the board. I put a low probability on that. I put a high probability on this, which will lead to retaliation. But in my model, Trump doesn't care about that. Trump doesn't think that far ahead in my particular model. So you have to look at the situation, and you have to build a model. Now, when you're building model, you have to be very careful where you attribute the complexity. So let's say that there's an ant walking on the beach, and you extrapolate its pattern as it's walking on the beach, right? And you take this pattern out, and you're going to analyze the pattern of this ant. To what do you attribute the complexity of the path? Do you attribute the complexity to the ant? That is going to require one hell of a model to describe the behavior of the ant in other contexts, right? Or do you attribute the complexity to the beach? If you attribute the complexity to the beach, you would have a different model of the ant in different environments, right? If you attribute this to the beach and you were trying to explain the beach, then you know it's about waves and wind. Right? The complexity that you see is waves and winds, which do not belong to the ant. You must do the same thing with Trump. So with Trump, you see actions and reactions and actions and reactions. And you're taking this, do you attribute this to Trump, or do you attribute this to the environment? If you attribute it to Trump, you're going to have a very specific model of Trump, in that he looks like he's playing 3D chess. He looks like he's angling for something else. He's a negotiator. He's a deal maker. Nobody knows the mind of Trump. It would be difficult to determine what he's going to do next. My model attributes the complexity to the environment, not to Trump. In fact, I attribute simplicity to Trump. And once you take the complexity away from Trump, and you conclude that he's not playing 3D chess, he's not playing 2D chess, he's barely playing checkers. In my model, Trump is slightly more intelligent than a bag of hammers. Now, you can disagree with that all you want. The only thing that matters to me is it useful? And it's highly useful. It is very useful. It explains almost all of the executive orders he signed yesterday, dealing with straws, dealing with corruption in the companies that can't use bribes in foreign dealings. I'm paraphrasing, but it's the Corruption Practices Act, the repeal of the Corruption Practices Act. It explains no tax on tips. Why does he want no tax on tips? My model explains all of that and explains it quite well. The data fits my model very well. And I don't have a complex model. I have a very simple model. And that is the test of a good model. The simpler the model, the more parsimonious the model, and the better it fits the data, the more useful that model will be. My model of Trump is very useful because I do not attribute the complexity to Trump. much like you would not attribute the complexity of the pathway to the ant, but rather to the environment, right? And then you come up with different models. You can come up with your own model. If your model is that Trump is this master deal maker, this amazing negotiator that the world has never seen before, that he is playing on a level that no one can comprehend, you're going to have a very difficult time in forecasting what the effect of what he's going to do is. That becomes a very difficult model. I would say that you are overfitting the model to the data at that point by contributing all of that complexity to Trump. Strip the complexity away, build a model in which you attribute simplicity to Trump, and just ask if it's useful. You don't have to agree with it. Does it make money? Mine does so far. Would 9 million cut in government spending equal a greater than 9 million loss in aggregate demand by the Keynesian multiplier? True. If you lose it, yeah, and if it was a true transfer payment, the multiplier is what, 1.6, 1.7, so it does amount to more. Yeah. Is it feasible for the volatility smile to be skewed more towards the calls? Well, that is how you get a smile, is with call buying. Skew is quite common. Whenever we look at volatility, skew is quite common at an index level. So SPY, IWM, etc. Skew is the most it's very rare you'll get a smile. It's mostly skew because these big ones are used for hedging. But at the individual security level, you get a smile because it is for calls. I'm sorry about the beeping. I can't seem to locate where that device is. I'm looking around my desk right now, and I don't see where I have the device that's beeping. Well, I can't stop it. Let's continue on. Regarding retail buying the dip, in the article you show it says there's massive buybacks by corporations. Why do you think that is at a time where their shares are so expensive? A lot of executive compensation is tied to the share price. And there has been quite a bit of pressure over the last 15, 20 years by funds to return capital, not through extra dividends because it's tax inefficient. It's not as tax efficient as capital gains, but through share buybacks instead. So companies are motivated to see their share price go up because that makes investors happy and it makes management happy. I will be studying business later this year. Is that included in the Discord, or is it only CFA related studies? It's not CFA related. It's applied level. There will be, if you're CFA level 1, level 2, level 3, even if you're not applied level, but you're in the CFA program, in you come. You may not be able to contribute to certain conversations, but you could certainly observe some conversations. You're in the club. Business schools? Yeah, I think so. Again, my first priority is getting the applied level subscribers over to Discord, which is a two-step process. Step one, hopefully, I think maybe later this week, early next week, step one is ready to go. It's not that easy to get thousands of people over to Discord. Of how many of them would even have a Discord username, right? So it's the porting over is going to take some time. Okay, I know that thing is somewhere and I cannot see it. Did you hear it? It's going to bother me. I can hear it. I know it's somewhere. I just can't see it. All right, let's keep going. Can you explain more about I already did that. What time period would you use to determine equity risk premium? Ooh, that's a good one. The Meldrum's recent 4.33 for Canada and US seems too low based on historical data of around 5.5 or 6. Well, there are, it depends on what you're using for the risk premium. I've seen it used with bills and with bonds, right? The bond, usually the 20-year is what you would use. And because yield curves, if you're looking over longer periods of time, the average yield curve is typically upward sloping. On average, if you take all the rates on average, you get an upward sloping yield curve. So if you think that there's some constant equity risk premium, the premium over bills will be higher than the premium over bonds. So is the 4.33 premium over bills or a premium over bonds? Fernandez survey of industry practitioners also has ERP around 5.5. BVR cost of capital studies uses year 28 to 24. How representative of our current environment? Well, I mean, I don't know that I would say that it should be representative. The 28 to 24 is a long enough period to blend everything out. ERP came out to 7.15. S&P average annual return, 10-year bond. Oh, minus the 10-year. Okay, the S&P minus the 10-year T-bond average. Okay, well, now S&P, you got to be careful here. If you are calculating a beta, you should be using, for the U.S., you should be using the Wilshire 5000. You should be using the entire stock market, right? Because what you want is one factor. You want the market factor. You want size and value to factor out. In other words, you have all the sizes in there, large cap to small cap, so that they balance out. So that, the large cancels out the small, the value cancels out the growth, so that you have like almost a zero weighting, because you have fair enough representation on both, so that most of your loading is on beta. When you go to S&P, you do have core in S&P, but you have large cap, right? So you would expect your premium on small cap to be higher. Not only that, you have a beta very close to 1 over here, so that if you were doing small cap, well, you'd have a beta greater than 1. You'd have to look at the ERP is for a well-diversified portfolio. He's using the ERP over the S&P 500, which is okay if you're using the S&P 500 as your primary investing tool in your benchmark. But I don't know how representative that ERP would be over another index in another country that is not the S&P 500, or is not representative of or comparable to an S&P 500, right? I'm valuing small to mid-sized companies primarily in Canada. Well, there's a problem, because this beta that they got, that 7.15, has some other factors in there other than the market factor. I'm not comfortable with ERP of 4.33. And you wouldn't use 4.33. I mean, you are using a risk-free rate if you're using CAPM, which should be your 20-year, right? Plus, you're going to use your beta times your ERP. The beta on your small to mid-cap is going to be greater than 1. And then you have to look at the Canada beta versus the US beta. So if they're attributing... Is the 7.15 the S&P over the 10, or is that the Canadian one? This is 4.33. His is 4.33 for Canada. He's probably using the 20-year to get that done. And that's probably for, well, you'd have to figure out, what was his beta proxy? Was it an index? A specific style index like the S&P 500? It does have a style. It's large cap. Or was it the Wilshire? Was it the broad equity index, which only had beta in it? Yeah, so then you'd have to account for the beta. The other thing that you have to be careful for is the difference in leverage between, if you're using the S&P 500 versus small cap, there might be a difference in leverage. You might have to unlever one of the first beta and then re-lever it with the different leverage ratio. So who would have thought that something so simple could be so complex, right? So I would go back to what Aswat did, and I'd say, well, what was your proxy? Was it the S&P 500? And if he's saying 433 for Canada, is that a levered or unlevered beta for Canada? Is that based on, you'd have to find a comparable index as well. And if that's just the ERP, then you'd apply your beta to that ERP. So let's say that your beta was 1.3 on 4.33, right? Now already you're somewhere around 5.5 on that one. And that's assuming equal leverage. If you have higher leverage in the indexes that you're looking at, this goes higher, right? Do you ever binge watch stuff totally unrelated to finance? Binge? No. I can barely get through a 1 hour episode of something. Top 3 web series or movies. And then the only thing I really watch is Severance every Friday. I've tried to get through some other stuff. I started watching Yellowstone. I think I got halfway through episode 2 and I thought, I have no inherent interest in this. I don't know what everyone's talking about, but I have no inherent interest in this. I find it hard to get, it's hard for me to get through a whole movie. Like a 2 hour movie, I watch it over 3 parts. Just, that doesn't hold my attention. Academia. How did you enjoy your experience doing a PhD? I enjoyed the conversation. I enjoyed the debate. I enjoyed all of that. I did not enjoy academic research because it was so removed from the real world. Academic research is not that fun. I'm currently considering doing a PhD in something finance related. Well, you better like research. And it's not market research. Even though you're using market data, it is academic research. That's a different thing. I took both CFA level 1 and 2, currently studying for level 3. I don't even work in finance, but I've come to just enjoy the experience of learning this stuff. I seem to be good at it. I would like to continue learning. I hope what I learn can eventually be applied to something useful one day in the real world. Well, then you don't want an academic. A PhD is teaching you how to be a researcher in an academic setting, which is not the same as a practical setting. In academics, it really does not matter if something doesn't work in the real world. It doesn't matter. So much of the finance literature, academic finance literature, 99% of it is completely useless and a waste of everybody's time. Completely useless. There's maybe 1 or 2 journals that are worth reading. Maybe more than 1 or 2. Journal of Portfolio Management, Journal of Finance, those are good ones. There's a few target journals that are okay, and in those 20 to 30% of the articles might be interesting and have some application that you can use, or some result that you probably already knew, but you didn't have the data to back up what you already knew. But much of the academic literature in almost all these fields is just useless. It's great for getting you tenure, but that's about it. No one's quoting you in the real world. How useful did you find your PhD in terms of knowledge? The knowledge you gain is not so much in knowing this and knowing that. The knowledge you gain is in how you see the world. You do see the world differently after. You do see arguments differently after. You spot weaknesses in arguments a lot quicker. You can organize your thoughts better. You can build models in your head faster of how you begin to describe the world. You start to organize things in your mind a lot better than before you go in. You see through complexity because you're always pushing towards simplicity, always towards simplicity. So it does give you a better outlook on how to do things in the real world or how to navigate the real world. But 4 years, 5 years, and a dissertation to get to that level? Would I do it again? Not if I had alternatives. I went to do a PhD at a time where, well, I don't know what I'm going to do next. Maybe I'll go do this. And my intention was never to finish it, but just to hide out there for a while. And, well, I just kept going. The process was fun. I enjoyed the conversation. I enjoyed the debate. I enjoyed those seminar rooms. That was where the life was in that. But when it came down to writing out this stuff, to writing an academic paper. It was so boring and so tedious and useless, so useless. I couldn't do it. So some people love it though. The fact that big tech stocks have had such big gains in the past 2 decades, doesn't that mean all these analysts and their estimates of future growth of these companies have been laughably wrong? Laughably wrong. The only 2 people that can use those words is somebody who's never ever been wrong, or somebody who has no idea what they're talking about. Which one are you? Are you one of those people who have never ever once been wrong in any of the forecasts you made, or are you one of those people who've never made a forecast? Laughably wrong. It's not the point of, first of all, it's not the point of an estimate. Year after year for 2 decades. Who are these people you're pointing to? Who are these analysts that have been laughably wrong year after year for 2 decades? Who are they? I mean, you seem to be grouping everyone into them. You seem to have some kind of animosity towards this group. Who's to say this pattern is to be changed now? What pattern? These overvalued prices might just be closer to intrinsic value than they've been before. Well, okay. Maybe they're fairly valued. Maybe they're overvalued. Maybe they're undervalued. Why don't you make a prediction and see how that works out? The prediction is not important. The price target is not important. That is the least important thing of a model. Much like your regression equation is probably the least interesting thing about your regression. Most of your work in regression lies in the errors, not in what you can explain, but what you can't explain. A model will take you down because of the errors. Any model will take you down for forecasting because of your assumptions, right? A model, your future price, is based on a bunch of assumptions that you have to make. Why? Because it's the future. It's unknowable. You have to make some assumption of what you think the future is going to look like. How are sales going to grow for this company? Well, you don't know. Nobody knows, but you have to have some kind of assumption that you base it on. You say 5%. Well, justify the 5%. So there are a bunch of assumptions like, well, this variable will grow at 5%. There'll be relationships between cost of goods sold and revenues that'll be fairly consistent. Maybe margins will expand by 30 basis points over the next year. So you have a bunch of assumptions. And then as time goes on, you get data points. And these data points allow you to go back and say, were my assumptions too low or too high? If my assumptions were too high, my price target is probably going to be lower. If my assumptions were too low, my price target is going to be higher. So it determines whether or not you think that based on the price target you have, that you said something is fairly valued. News comes out, you look at your assumptions, you say they're coming in above assumptions. Chances are the stock is undervalued instead of fairly valued. So it gives you a starting point, an anchor point by which to say, look, I have no idea what the future is going to look like. So let me baseline some things. This price target I have, if you want to think about it in a particular sense, is a conditional statement, conditional on the assumptions that I've made. And then I can go back, I didn't mean to write ass, conditional on the assumptions that I made. So what I can do is I can engage in Bayesian updating now, that as data comes out, I can visit my assumption to determine whether my price target should be higher or lower. It gives me an anchor by which to guide by, right? So revisiting your comment, laughably wrong, I can tell you're one of those people that don't make predictions, that don't engage in forecasts, because you would understand that the price target and the forecast is not the point. It's the assumptions that are the point. Engaging in this makes you uncover all your assumptions, so that you surface all of these assumptions so that you know what you're looking for when information comes out. Anything that deals with those assumptions you made, that's what you're looking for. So if a company says, this we have done today, Rather than saying, well, I don't know, what does that mean? Let me look at the price. Let the market tell me. Oh, price is going up. It must be good. Most people end up doing that. Oh, it must be bad. The price is going down. Last week when Uber took a drop down to 65, 64, I knew what I was looking for, and I immediately sold $65 puts on that thing, right? But everybody else who just says, oh, well, all these things are meaningless, didn't understand the process, would have looked at that and said, well, I don't know. You don't know because you don't know what assumptions that you would base your valuation on, right? So don't be so quick to pass judgment in such a derogatory way, laughably wrong, because, from my perspective, your statement is laughably wrong, right? Any comment on Freeport's poor performance compared to the price of copper? The mining companies just have not been going along. Gold mining companies and copper have not been going along. Gold, all-time highs. Newmont should be flying out the door. No, 45. It hasn't regained the $50 range it was in, not too long ago. Same with Freeport, still sitting under $40, just not participating. So that's why I had said about a month ago in the applied level for positions that I'm interested in gold and copper again, but this time I'm not going to get my exposure through equities. I'm just going to get them through futures. Research many of the best performing equity mutual funds across market cap and style. Amazes me how most of them are pure bottom up stock pickers. They literally don't take macro conditions into consideration. Yeah, I can see that. They're significantly overweight or underweight sectors. They seem to be in stark contrast to you and I who heavily consider the macro story when deciding where to invest. Oh, that's easy to explain. A mutual fund, first of all, a mutual fund has a benchmark. And the other thing that a mutual fund has, another constraint, is the fully invested. So let's say that you were a small cap growth fund. What do you care what the market's going to do? I mean, what do you care? You have to be fully invested. You don't have a choice. You can't go to cash. That's way outside your mandate. You have to be fully invested. You're going to have very tight constraints on your beta as well, such that you can't hedge out 100% of your beta risk. That's not in your mandate. Your mandate is to beat your benchmark. So if your benchmark is going to drop 50%, let it drop 50%. As long as I only drop 48, let it drop 50%. The only thing I got to keep my eye on is the benchmark. I don't care about macro, because my performance is relative to the benchmark. If the benchmark gets its ass kicked, as long as I get my ass kicked a little less than the benchmark, I'm okay. I got to be fully invested, so I kind of have to be in small cap growth, so I better be a stock picker. I better be good at picking the companies that will beat the benchmark. I don't have the choice. Now, if you're a hedge fund, on the other hand, you don't have a benchmark. You have a relative performance, and that is usually the cash rate plus some spread, usually about 400, 500 basis points, or more often a hurdle rate of about 8%. That is an absolute return, which means you have to care about markets, because if the market's going down 50%, you must still beat a positive hurdle rate. So you have to care about where the market's going. You have to care about beta and duration. And you're more than likely to use futures and options and currencies, but the the mutual fund that is small cap growth is small cap growth, fully invested in small cap growth. Can't do that. So who cares? If you tell one of these managers, oh, a real storm is coming. So what? They're not selling. Oh, they may rebalance in different environments to say, well, I think if I, lean in over here, I could beat the benchmark. And it's all they're trying to do is beat their benchmark. That's it. So if that's what you told me, you can only be in S&P 500 stocks. You must be fully invested at all time, except maybe 1%, maximum 1% you can hold in cash. Fully invested at all times. At that point, I would say, well, then what do I care if the market's going up or going down? What do I care? The benchmark will go down. I'm following the benchmark. I'll follow it down. I just want to follow it down by less. I'm not trying to beat zero. When you're trying to beat zero, then you got to care, right? Can you share your thoughts on market reactions to tariffs? Well, there were no reactions yesterday. The market was green, which gave me, because of that, it gave me a very high probability that Trump was going to do it. He was going to implement those tariffs because his test, which is the market, didn't react. So he was going to do it. So that means yesterday when the market was up, I saw it. I go, well, this is going to happen. Let's go ahead and short. So I took a short. Well, on top of the shorts that I had, I added more. Are we getting numb to threats, or are we ready to take the original 25 in bite-sized pieces? I think there was a little bit of denial from the market. I think, from what I'm hearing, when I hear different analysts talk, unless they're afraid to actually speak their mind because, well, you know how Trump is, right? When you say something bad about him. I think that too much complexity is still being attributed to Trump, and that he's trying to get something else done. No. Well, again, in my model, the answer is no. I think it's just going to be delayed reaction as everyone tries to figure out the complexity. Oh, what's he doing now? Oh, he's 3 moves ahead of everybody. He can't figure this out, and still thinking, well, it's going to work out because he's a deal maker, right? He's the king negotiator, right? I mean, this is all really going to work out for the U.S., right? Nope, not in my model. In my model, he's like I say, slightly smarter than a bag of hammers. Anybody watch the press conference? It's not so much a press conference, the executive order signing ceremony in the White House yesterday, where he signed a bunch of orders. Howard Lutnick was standing right beside him. Couldn't kiss his ass hard enough. Twice. I am so impressed with you, Mr. Trump. I'm honored to be standing beside. Couldn't kiss his ass enough. When asked about paper straws versus plastic straws, Trump had a lot to say. Of course he has a lot to say because he has experience with it. He has resorts and casinos. Resorts and golf clubs and golf clubs. Well, yeah, they're called clubs, right? Golfing clubs. It's more expensive. So yeah, he wants to go back to plastic. It's cheaper. I mean, that one he could talk about a lot. When the Foreign Corrupt Practices Act, he could talk about that a lot because there have been a couple of times where trying to get a property somewhere to build a golf course or something required that he would have to breach that contract, where bribery would have made it a lot easier. So, well, let's just get rid of it. So it is going to benefit him in that sense. When it came to the tariffs and the guy handing him, I don't know who his name is, hands him the thing and explains what it is. He's saying, he used the word ad valorem, and Trump looks up at the crowd of reporters and goes, you know what that means? And there was silence. Oh, it's going to be a very big thing. Trump doesn't even know what it means. In my model of him being simple, when he looked up and said, does know what it means? In my mind, I saw that. I thought, you don't even know what that means. And he didn't even answer it because he didn't know what it meant. Oh, it's a big thing. And then he got Howard Lutnick to explain, hey, maybe you can explain it to them. And he didn't even know what it meant. He doesn't know what the word ad valorem means. So I think, I don't know so much that we're getting numb. I think that the market just hasn't got the right model for Trump yet. They're still attributing far too much complexity to the person. He is quite simple. In my model, he's quite simple. Yeah, we'll just leave it at that. I think the market will eventually catch up with it. Canada's already said there'll be firm reactions to this. The EU is already threatening the same thing. There will be reciprocation. There will be. The last time this was done, the Wall Street Journal had a very good story on it, and there's a very good video on YouTube. I don't know whose video it is, but it's a more serious one about what happened last time in 2018 when he raised tariffs. It did have some impact, but only on prices. It did raise prices. It did raise profitability. It raised I think the average cost per consumer, the average cost per car went up. And it turned out that with what everybody had to pay extra for the jobs that were created, Wall Street Journal concludes it was something around $800,000. It cost $800,000 to create each job in extra expenses that the American consumer had to pay. That it was a dismal failure overall, and this will be a failure as well. This is not make America great again. This is make America low value again. It's Malva. I think we need new hats instead of MAGA Nation. It's Malva Nation. Make America low value added again. Would it be better to sell puts and calls in volatile market or to capitalize on buying both puts and calls? You buy both puts and calls when volatility is low and you expect it to raise. You sell puts and calls when volatility is high and you expect it to fall. Assuming Fed starts selling MBS, what's going to happen to your two favorite picks, agency and ABR? Well, ABR doesn't have MBS. It's classified as a mortgage REIT, but it doesn't have MBS. It has loans. It makes real estate loans to companies who redevelop properties. So I don't know that it's going to have too much of an effect on ABR. What has an effect on ABR is the 10-year. The higher the 10-year, the worse it is for ABR. And what will affect the clients of ABR is the amount of residential properties coming to market, especially in the B space or in the lower priced area. That will affect ABR the most. Agency hedges out the interest rate risk and then levers up the spread. I think their leverage ratio is, 7.5 to 8, somewhere in there right now. I don't think the Fed would sell MBS at a rate that would dislocate that market. I think if they'll announce it, and they'll announce a certain rate that is small enough for the market to accept. And when they see that rate is being satisfied, they may increase that rate slowly over time. But I don't think that they would just say, okay, we're going to sell it all in the next 6 months. You'd destroy the MBS market if you did that. Spreads would widen out because the amount that you would be dumping onto the market. Fed's not that lacking in skill. It'll be in a pace that the market can absorb. 25% tariffs, 48 hours after meeting the Japanese to negotiate an investment in U.S. steel. Yeah, could it be too far-fetched to suggest that he feels like a case of government for hire? I don't know what that means, government for hire. Feels like a case of government for hire. Well, Trump is transactional, right? There are no relationships with Trump. Everything is a transaction. And there are two actions that he takes. The first group of actions are things that would benefit him or his businesses directly. So, for example, reducing regulation in the financial sector. If you look at what his company is doing, they're registering trademarks for ETFs to launch ETFs. Well, you would want lower regulation to get a lot of that stuff done. And you want a very compliant SEC and a very compliant Justice Department and a very compliant FBI if you want to get all that stuff done. The other category of things he does is to extract something out of other people. So I'm going to sign these executive orders because I can see how they benefit me. I'm going to sign these executive orders because I'm going to extract something out of you that I can see how it benefits me. And that in my model, that's his MO. Trump really only is a one-trick pony. I mean, if you go back through his whole history and you look at how he's built his empire, he is a one-trick pony. Now, when you have money, you have a certain sense of power. And he was born into money. So he had a certain sense of power. And power is scary to be up against, especially if you're weaker. So it is power plus threats. That has been his MO his whole life, power plus threats. Says all his buildings came in under budget. Yeah, because he used small contractors And after they were done, he would sick his attorney, his lawyer on them, saying, "You did bad work. We're not going to pay you, and you don't have the financial resources to fight my guy. 50 cents on the dollar is what he's willing to pay you. Go away." And he would crush these small contractors, basically rip them off. And that's how his buildings came in under budget. Power plus threats, power plus threats, power plus threats. And then if you don't acquiesce, bully. Power plus threats and bullying. Power plus threats and bullying. That's his MO. Again, in my model of Trump, that's how he does things. So everything is from a position of threats. He's going to use the power he has to threaten. And if he doesn't get what he wants, then he's going to bully. The name calling, the reputation slandering, all of that stuff. He's just going to bully you. Worst person ever, crooked Joe, stupid this, stupid that, dumbest person ever, that kind of stuff, right? Stuff you don't want in your life. But he picks on weaker people. What a bully does not want is, even if somebody is weaker, a bully does not want to get hit back. Even if the bully can beat them up, the bully doesn't want to be challenged. The bully wants to see fear. The bully wants submission, which is why when Trump smells weakness, he attacks even more, because that's what bullies do. He threatened Canada. Canada threatened him right back, and he said, okay, let's take the things off. And he agreed to what Canada already agreed to before Trump even raised the tariffs. So he got nothing out of that. So my thinking of is he going to put tariffs across Canada again? No, because a bully doesn't want to get punched back. Even if the bully can win, they don't want to get punched back. Power and threats don't work. The bully doesn't want to get hit. The bully goes away and finds weaker people. So I don't know that I would say that this is a case of government for hire as much as it is a playground bully that we've all met in grade school. A bully from 100 yards away, a coward up close. And that is Trump. That is his MO. That has been his only MO. If somebody's not doing what he wants, he bullies them. Now, a negotiator, you'd never know. You'd never know. You got a holdout in one of the Republican Congress that's not going to vote for your person. Trump would take that to social media and call that person out, call them stupid. We're going to primary you. You're going to lose your job. Call them every name in the book if that person wasn't on board. A true negotiator would call them up and say, listen, what can we do here? How can we get to yes? That's what a true negotiator would do. When your source of power is external, this is sort of what you use. Threats. When you have no internal source of power and only external source of power, you tend to rely on threats. But if you have an internal source of power, where you have a charismatic personality, you're cognitively above the other person, that you can think faster and move faster than the other person, that you can influence that person. That's an internal source of power. You tend to use that more often. Trump, in the end, is a beta male, but with the power that he was born into, he's a beta male acting like an alpha, but he's not an alpha because his source of power is not internal. Alpha males have an internal source of power. They don't have to rely on an external source of power. Trump only relies on an external source of power. So I don't know that I would say government for hire as much as you're looking at the very beginnings of the cult of personality that I think will dominate for the next 4 years. Do you have any of those deals for fellow PhYD professor types? I think maybe the Y was a typo, PhD types. Yeah, of course. Send me an email. I'll give you a discount code, sure. RRP balance is depleting, and also credit spreads and what they imply. Credit spreads are not implying anything. Credit spreads are basically just whistling their way around, going la la la, nothing to see here, and there really is nothing to see there. Week after week after week, there's nothing to see there. Reverse repo, once that hits zero, then reserves are next, right? Because the reverse repo is sort of like a I wouldn't call it a reserve, but a quasi-reserve. It is excess money in the money markets that needs a home. It has no home to find. The Fed doesn't want all that extra money changing rates. So what it does is it says, well, look, why don't you give it to us and we'll give you this much. It's easier if you just give it to us and we'll give you this much money, rather than hitting the market and changing rates. Once that hits zero, that means that there isn't excess money that needs to find a home. So where's it going to come from? Well, it's going to come from reserves. That means if there's a shortage, not an excess, but a shortage, then it's going to start coming out of the reserves. And since the Fed operates in an ample reserves regime, which looks like this in terms of the demand for reserves, well, they want to stay in the flat part of the curve. They don't want to end up here where it starts to change anything in the market. They want to stay in the flat part. Well, where is the inflection point? They don't know. So once reserves start draining, that's when the Fed has to start saying, whoa, let's slow down here. We don't know where the inflection point is, right? It's like driving on a dark road with the lights off. And there's a bend in the road somewhere. You know it's up ahead. It's not right here, but you know it's up ahead, but you don't know where. Best to go slow, right? So they're going to slow down. Once you see that thing hit zero, they'll start to slow down. 25% steel, yeah. You state an IV for each of SPY. The IVs are 30-day IVs, right? They're based on the puts and calls that are, I think, in the next 30 days. So it is the front month and some of the month after, based on where it is. So if there's 17 days left here, there's some weighting on here, and 13 of the days would be on. The CME has a description of how they weight it. The math is rather complex, so I didn't do a deep dive on it, but it's based on 30-day vol or implied vol. Federal Reserve, two primary mandates: maximum employment, price stability. True. Maximum employment being the most important. I think they would push back on that. I think they'd say they're both important. One would get more attention than the other, depending on which one needs the work. Trump has repeatedly called for lower interest rates. If you can't pressure Jerome Powell into cutting rates directly, he could instead create an environment that forces the Fed's hand. Well, Bessent was more clear on that, saying they're not interested in the overnight rate. They're interested in rates. In other words, getting the yield curve lower. As opposed to just the overnight rate, is to get the yield curve lower. Now, you could pressure the Fed to do that by saying, listen, why don't you sell some of those MBS? And with every dollar of MBS you sell, you buy $1 of the 10-year. So you're not changing the level of your balance sheet. You're not changing financial conditions in that sense by introducing more liquidity. You're just easing the 10-year a little bit. Why don't you do some of that? They might pressure them into doing something like that. Imposing tariffs that lead to higher unemployment, which it's not the tariff that will lead to the higher unemployment. It is what other countries do to retaliate that will lead to the unemployment. Canada is most likely to retaliate. Europe will retaliate as well. It's like, well, if you don't want our steel going in, we don't want the product of your steel coming out. So look for things like motorcycles, appliances, anything that's built with steel or aluminum coming out that's exported out of the U.S. into the Eurozone or Canada. It's like, well, you don't want our steel as an input. We don't want your steel as an output. Whatever you're making with steel, we don't want it. There is where it's going to cost jobs, is in that part right there. Imposing tariffs lead to unemployment, slower growth, and weaker stock market. It will lead to slower growth. Tariffs always do. They always do. Especially if you're the dominant economy, if you're the primary economy, tariffs will always lead to lower growth. Always. Might push the Fed back into rate cuts and even QE. True. Do you think his tariff strategy is designed to achieve this end goal? I don't think, no. In my model, he's not that complicated. He's not playing 3-4. That requires a mind to think 3-4 steps ahead, and a Napoleonic mind willing to lose troops to win the war. That's not how he thinks. It is as simple as it is. Whatever the sentence is that he says, it is as simple as the sentence that he says. There's nothing more to it. There's no second move. The first move is going to work out. look, this is actually good for both countries because prices are going to come down, we'll create more jobs, and everybody will be better off with higher, he just says things. I mean, companies are going to come to the U.S., they're going to invest in the U.S., they're going to build plants here. These are multi-billion-dollar plants, and he's there for 4 years. It's not going to happen. But in his simple mind, in his simple world, it will happen. So he's as simple as his sentences are. Don't look for any extra complexity. And again, that's my model of him. It works quite well in explaining his behavior and looking at the outcomes. If you attribute complexity to him, it just becomes more difficult. So no, I don't think that his tariff strategy has any extra move other than the move that's right in front of him. Do you think the risk of tariffs and threat of fiscal stimulus to deficit is already priced in? This is why the yields in the long end increase despite multiple rate cuts. I think the long end of the curve is reflecting the level of discomfort with the amount of government spending and the level of the debt. I think that's what the long end of the curve was saying. And I think the long end of the curve is saying it is more likely than not that Trump will make it worse, not better. Does your view on agency change as a result of this potential threat? Well, it doesn't change. It just, I don't know that agency, if the Fed does announce that they'll be selling MBS, I don't know that agency would then take that opportunity to increase its leverage. Offloading MBS, already talked about that. Desire to lower long-term borrowing rate. 10-year yield comes down. At the same time, Fed offloads agency MBS. What might we expect net effect on mortgage rates? Well, the mortgage rate, if you work backwards, if you have pressure on MBS pricing, which means you have higher yields on MBS, if I were going to securitize a bunch of mortgages, I'm going to have to pay a higher rate on the mortgages, on the mortgage bonds, which means the mortgages in my pool would have to have a higher rate than what I'm paying. They typically do anyways. And since they would have to have a higher rate, there'd be less pressure on mortgage rates to come down in line with the 10-year. Because who would securitize them? Right? If MBS bonds require, 5.7%, I'm making up numbers now, 5.7, and you got the mortgage rate down to 6.2, that's just not going to be enough. I'm not going to buy a bunch of mortgages at 6.2 and sell bonds at 5.9 against a 30 basis point spread. I'm not going to do that. That's, there's not enough built in there. So it would limit the downside move on the mortgage rate to account for the wider spread, I guess, between the 10-year and the MBS, if you had a supply of mortgage bonds that was more than the market could absorb. Bounce back and forth in this volatile manner without breaking any new high for the rest of the year. Be very happy. Typical contribution of federal hiring to the aggregate government hiring figures in the establishment report, usually about 35%. Hiring freeze affect more than 10 to 15,000 jobs. Yes, it will. I think so. Yes. I wonder if any buyouts would materialize on the next report. I don't know. This is a survey, so it's not really looking at initial claims. It wouldn't show up in initial claims for 8 months, because if you had the buyout for 8 months, at least how it works in Canada, when I get rid of an employee, you fill out a record of employment. If there is payment for a period of time, you have to put that down on the record of employment. They don't qualify for unemployment while they're still getting that. So if you had 8 months of severance, then it would be 8 months before those things would hit initial claims. But I wonder if on the survey, it would show up. Well, I guess for the establishment survey, if you're looking at government would say, well, we don't have these jobs. They may be still paying for the job, but they may not have the jobs, unless the question is about are you paying for a job? I don't know. Thoughts on all the DOGE cuts causing Congress to step in and wiping out all the progress made by issuing a massive spending package? Oh, that's not going to happen. First of all, that's not happening. But Congress step in. Congress is Republican. And all of them, if you listen to them kissing Trump's ass, they're all of them afraid of dear leader. All of them afraid of dear leader. I just don't see that happening. I don't see that happening at all. IW and IGR both have the same number. Yeah, I saw that. They, I don't know if that was just a fluke. You got 600 companies that are gonna have the same earnings as 1,848 companies. Kind of gives you an idea of how much more profitable IJR is than IWM. Higher Treasury yields Friday on the back of underperforming jobs release. Well, I think the higher yields was related to the average hourly earnings being so high. OpenAI deep research. No, I have not. Consensus among OpenAI and Anthropic is that we will have AGI by 2026. So the companies that are making it are saying you'll have AGI by 2026. Is that like Tesla saying we'll have full self-driving by 2014? I mean 2015? I mean 2016? I mean 2017? I mean 2018? 2019, 20, 21, 22. 20. Is it the same thing? It's just around the corner. You have two companies that are building models in this space that are saying it's coming, it's just around the corner, 2026. Is it the same thing? I don't know. Sam Altman recently mentioned fast takeoff might be more likely than initially thought. So again, is this just sort of the same thing of overconfidence of CEOs in their own product, right? I mean, I do the same thing. I start something and I say, 3 weeks. This will be up in 3 weeks, and it takes 6 weeks because it takes a lot longer than I thought it would take. But I do mean to do it. So in my head, I do mean to do it. It's going to be in 3 weeks. I have every intention of doing it, but it ends up taking longer because life happens, things happen. You get pulled this way. You start researching something and you realize, whoa, this is a lot deeper and bigger than I thought it was. Right? So, I mean, I do that. I have forecasts of how soon something will happen, and it never does happen that quickly. But I do get it done, but never that quickly. So I'm sure they believe that they're working towards this, but I do think that most CEOs are highly optimistic on their timelines. Any thoughts on Trump outlined tax policy changes, including eliminate the carried interest? That allows private equity and hedge fund managers to pay lower capital gains instead of ordinary tax. This proposal would tax this income at regular rates. So we can look at this in two ways. Number one is you need revenue anyways. If at the end of the year you're going to negotiate with Congress to extend the tax cuts, you have to have pay-fors, right? How are you going to pay for this? You need to raise tax revenue somewhere anyways. There's one way to think about it. Another way to think about it is extracting concessions. Is, okay, I'm going to threaten to do this to you guys. Now what are you going to give me in return for me not to do it? Right? That is in line with Trump's negotiating tactic is hand you some misfortune and then negotiate that misfortune away by extracting something out of you. Get something out of you to remove the very thing I put there. So it could be that. It could be that he has no intention of actually doing that, but maybe some donations to some Republican re-election campaign. Maybe you guys didn't give money to my inauguration fund. Maybe, I don't know. Could be something along those lines. It could be that you guys are not holding any stock in DJT. In Truth Social, you guys aren't holding any stock. None of you private equity managers or hedge fund managers are supporting anything that I have. I have these ETFs. How many of you are going to hold these ETFs? I don't know. I don't see it going. So, here's a problem I'm going to give you. Wouldn't it just be cheaper to hold my stock, right? In my model, that could be an end result. Auto loans, mortgages are priced on 5, 10-year. Yeah. Is anything priced on 20 to 30? Some life insurance premiums are regulated based on I'm not quite sure what the formula is, but it could be that if the return on the float is significant enough, and for life insurance companies it is quite significant, the investment income that they make, that their level of profitability might change the rates that they charge for insurance. So maybe life insurance off the 30. Any reason the Fed would replace MBS runoff with 5-10 but ignore 20-30? Well, the 10 is the big one, right? But I don't know that you'd get such a big slope between the 10 and the 30 before you get investment saying, well, what do I want the 10 when I can grab the 30 and hold that for 10 years? Look at the slope between the 10 and the 30. In the case where they buy only 10-year and under, would that bring the whole curve or just steepen the curve? Initially, it would steepen the curve, but it would bring the long end of the curve down. Maybe not in lockstep, but it would bring it down. Strong relationship between per capita GDP and a country having the capacity to fund infrastructure. Understanding is that only when a country reaches a level of about 4,000, they are wealthy enough to fund infrastructure. 20,000, they become more services based. If this is true, how would a country like India fund infrastructure given their per capita is far below 4,000? Well, you could do it on a hub and spoke basis where the infrastructure goes to the more affluent areas or the richer areas. So maybe the country as a whole has a certain GDP per capita, but if you take a certain city, it has a higher GDP per capita. It could be something like that. Where India would more likely benefit is by focusing on ports first, rather than internal infrastructure, especially going into the middle of the country. I think if they focus on ports more, that would be the first step in producing an economy that has the infrastructure to import and export. In other words, develop the trade part of it first. For that, you can definitely have infrastructure funds from around the world participate in that. If you feel that the infrastructure can raise the GDP of the country, a lot of these infrastructure projects have a handover clause at the very end. So I will build a port and I will run a port for 30 years, at which time ownership transfers to India. That means I only have 30 years to make back my money. And it's usually set up such that I can make my money back in those 30 years. And then ownership then transfers. There is no residual value to the asset. Ownership then transfers to the state. So it is a good way to get to really get up to speed quickly on the infrastructure without having to buy it out at the end. At the end, you simply just get it. So it could be something like that. Market and analysts are expecting uncertainty and volatility. Yep. What is rational for IG and high yield credit spreads to remain at historical lows? I know. Well, they're well-run companies. You could say, well, they're corporations. They're not governments. They're well-run. But yeah, the spreads are, sort of nothing to see here. I'm not going to answer this one. Downsizing the federal workforce won't significantly move the deficit. The big waste that DOGE won't address is the retained earnings that private military and healthcare conglomerates take for their services for defense and healthcare entitlements. They're moving on to defense and healthcare next, I think. Looking at the waste that Medicare Heritage explicitly states in the mandate for leadership. I don't know what that is. Medicare Advantage will become the default enrollment option for new enrollees moving forward. Last will mean big gains for M8 conglomerates. Okay, well, that's not a question, it's just sort of a statement. Plan for Discord, I already have that. For the rate cuts here, I I was looking at something that said 95.94 and it was at 4.17, and I did this as opposed to saying that it's 4.06 instead of doing this. I was doing it to I was taking the 17 to the 94 instead of 17 to the 6, so it was off by 11 basis points. You're right. What can I do to pursue finance? Just pursue it. You're a bio major, you're interested in finance. That means you know how to learn. And if you're interested in finance, I would say just do it. A lot to worry that a rapidly declining reverse. Oh, already did that. Already talked about that. India's tariffs, luxury cars, 70% customs duty. Woo. Previously 125 to 150, 40% AIDC, agricultural infrastructure development surcharge, previously zero. Oh, that is ugly. Valuations, given rising share of tech in S&P, is it possible we're currently fairly valued? Anything's possible. It's possible we're currently fairly valued. It's possible we're currently undervalued. It's possible we're currently overvalued. Sorry, that isn't the important statement. What assumptions would you be making? Right? It is possible, sure. Let's see. Already talked about that. Okay. Reduce the defense budget. Interesting, good short candidates to pair long positions, somewhat beta neutral. Well, I don't know. I don't know that their plan is to reduce the defense budget. They're just going to the defense budget next and figuring out where the waste is. And I assure you there will be waste. President election cycle theory is relevant to what is happening. It's just more extreme this time. I don't think Trump will let things run wild in the market. His priority in near term is clearly politics over money. I don't agree. How many more times will they manage to pull this off? Retailers buying the dip until it doesn't work, right? This is the thing with momentum is when the retail investors get into momentum, they buy the dip, even the last one, and that's usually what wipes them out. What impact would a Trump-Musk fallout have on duration? I don't think any. You have Elon, who seems to have good intentions by cutting wasteful spending, but if that relationship were to end, I don't see anyone else coming in to purge government waste. Oh, I see. You mean in that sense. Well, that's interesting. Yeah, that's interesting. I don't know what effect that would have, and I don't know if there wouldn't be somebody else that comes in to take care of it. J.D. Vance seems to care a little bit about it. Maybe he would step in. Could a value screened R2000 be more attractive? I don't know. I already answered that. I already answered this one. Do people need a background to understand a sector? Well, yes. I mean, you do have to do some research to understand the sector. Financial modeling, but financial modeling is based on a lot of assumptions. Yep. Which can be true or false. Yep. So why do people need it? It's just assumptions. That's the point. It's the assumptions, right? That is the basis on which you're making your decision, your assumptions. So you want to be aware of anything that challenges your assumptions. Is CMT a good designation to have or a waste of time? You're asking the wrong person. When it comes to technical analysis, you are asking the wrong person. It would be like asking me what religion should you follow? You know, none. Trump has laid off quite a few Fed boys. Fed? From the Fed? Do you think, or federal workers, do you think the duration will respond well to lowered spending? It should. It should. There was a narrative that Trump would be worse for the deficits. Well, we're still not certain about that. We still got to see what's going to happen with the tax cuts at the end of the year. Ever shorted speculative stocks like cannabis stocks? Nope, none of those. But I have shorted speculative stocks. If not, do you think it's reasonable to short unprofitable stocks? You got to watch stocks that have big followings. Momentum can last a lot longer than you think, and you could go broke shorting those names. It's best to wait for momentum to break and then short it. Do you think that factors reducing aggregate demand will outweigh the Trump put for beta? You combine a tariff war with spending cuts. Yeah, I think that will outweigh what Trump can do for the market. Fed starts selling MB. Already answered that. Given the context of DOGE and the constitutional overreach. Constitutional overreach or executive overreach? Do you think we could be heading for a major showdown and that could take markets down with it? No, not with what he's doing. I think that can unravel Washington very quickly and ruin some reputations. But constitutional overreach. I mean, didn't Biden do that with declaring all the student debt forgivable? Didn't the court overrule that, saying, whoa, you don't have the authority to get that done? Don't all presidents do that? Reach until they get shut down? Oh, where else are you going to find the limits of everything unless you reach? I think they'll push as far as they possibly can, which I think anybody would push as far as they can. We know Biden did. Biden certainly did. So I don't know that this is new. It's just done with a different attitude, right? And it's just done from a different ideological perspective, which may make it seem worse. If my friend is drinking too much, that's okay because he's funny. But if my enemy is drinking too much, he's a raging alcoholic and needs to be dealt with, right? Different perspective depending on what side of the field you're standing on. Rational thinking would assume that you're right about Trump administration focusing on long end of the curve. Yeah. When has Trump ever been rational about anything? Well, it was more Besant that said it, not so much Trump. I could still see him starting his attacks on Powell and the Fed. Yeah. What is behavioral finance? How can we learn it? Thinking fast and slow is probably the Bible out there as far as a collection of all the behavioral biases. Behavioral finance is how we behave in a financial context. So it explains the micro, but not so much the macro. You say you don't believe in reports coming out of China. Why? Because it's China. Can we say the same thing about the U.S.? Not really. Can the data be manipulated in the reports coming out of big institutions like Goldman? No. To keep things under control? No. That would assume that there is some secret cabal. No, I don't buy into that stuff. Why do people like Elon Musk or Steve Jobs take all the credit of the engineers who actually build all the things and present themselves as the next genius when they themselves don't know how to write a single line of code or anything about rocket science? You sure about that? Well, the other story is how come all these people who are doing this stuff don't build their own business? Some people are leaders. Some people want to be led. That's how it comes down to. Leaders get the glory, right? Because they harness the power of those who follow to reach higher than any one of those individuals ever could have done on their own, right? Skill without purpose is just latent skill. Sometimes you need a leader to bring the best out of you and to construct the team that actually gets this done. So there is something to them in that sense. And that will take us to the end of the questions this week.